So I'm Catherine Thompson, technology analyst at Edison, and I'm here today with Aylsa Muir, CFO of Checkit. Welcome, Aylsa.
Thanks, Catherine.
To kick off things, could you give us a brief introduction to Checkit?
Yeah, of course I can. Checkit is a company that provides digital solutions to multi-site companies. So these are companies that have disparate workforces or locations and sites, etc. And they help them in real time manage their assets and people tasks really, and collect that data and dashboard in real time to help them make decisions. So that's the official, what we do and what the value proposition is, just to help get that in more of the real world and give you some tangible examples. We work with healthcare providers, food retail, doing things, anything from monitoring something like a vaccine fridge, or creating real-time workflows and digital checklists and dashboards for multiple food retail outlets, for example. So it has a multiple of uses. It's a business that's come about despite being listed for over 70 years. It's actually come about through a huge amount of change, particularly over the last 18 months and 2 years. And as sort of two businesses now pulled together to create this new software business with a strong presence in that food retail and healthcare. Work in five core verticals. Two I've already talked to you about. The other three, pharmaceutical, facilities management, and franchise, particularly quick serve restaurants, are other sort of verticals we work in. So really, just to summarize all of that, we really see our solutions as the future of business operations management, and particularly in this accelerating digital world. Our subscription based solutions help organizations make quick decisions and improve returns across a whole number of important metrics.
And the company, as you said, has recently been through a period of restructuring. Could you outline the growth strategy for the business and, bearing in mind the recent US acquisition, what your plans are to grow in the US?
Yeah, absolutely. And anyone who's followed the business or the announcements, particularly over this second half of the previous financial year, will have seen just the amount of construction and restructuring that we've been doing in the organisation. That's a rapid transformation program, and with one thing in mind, really, which is to build a scalable and aligned operating model ready for growth. So that's what it's all about, making it fit for growth. So that suggests that we're poised on the base of a solid customer foundation. We've got some good, strong brand names that we're in now, and with a scalable operating model, we're set to emerge out of the pandemic and really focus on growth, and in particular growing subscriber numbers. That's absolutely key for us. We saw that was indicated in our announcement of last week. We'll see it in the trading announcement today as well, further, that the acquisition in the US and the hire of the two key roles shows that not only the UK but the US is a really core market for us. So the acquisition and the hire of a US MD should help springboard us into what we see as a really core market for our product and solution.
And could you talk us through the key highlights of today's trading update?
Yeah, sure. The three highlights really that I'd like to call out of this trading update. Firstly, FY21 was a strong performance year, despite all the challenges that we faced, particularly in the first half of the year, when many of our field engineers, field resource were grounded or furloughed due to site closures. Despite that, we've managed to grow revenue this year. And we have closed with a stronger cash position than we would have expected. So we've exceeded everything that the board would have thought. And that's shown, if we look at our trading update today, we've announced that we expect our profit outturn to exceed previous estimates by around 15%. So that's a good performance at exceeding what the board expects. The secondly, just recurring revenue. So within those results, our recurring revenue, the bloodline of a subscription-based business, in quarter four saw the largest year-on-year growth that we've seen all year, and actually closed the year with some really strong double-digit growth as a result of three things really, which were the continued conversion of maintenance and calibration contracts in our healthcare organisation into recurring longer term subscription contracts, some harmonisation, rationalisation of pricing across the board, and then thirdly, new subscriptions and new customers coming on board. We particularly saw that accelerate in the last quarter of the year when we were able to re-enter sites and get customers live, particularly in the healthcare sector. So recurring revenue growth, really, really strong and continuing on the trend we've seen all year. And the third highlight, similar to what we just talked about, really is this indication for growth. There'll be more coming out in towards the end of quarter one, we would hope, but the indication from the organisation that we are set to invest in our growth going forward.
This update for the first time gives the annualised recurring revenue metric. Can you explain what the significance of that is and how you hope to grow this?
Yeah, absolutely. So anyone who works in a recurring or subscription-based business, particularly in software, knows that the recurring revenue and particularly contracted revenue is like I said before, the lifeblood of the organisation. So for me, it's a really good indicator and the best indicator of underlying business growth. Unlike recurring revenue reported, it removes all of the element of timing of the landing of contracts or anything like that, and it actually talks about your annualized contracted revenue growth. So we can see that our ARR closing in FY21 is actually around 50% higher than it was when we exited FY20. And it gives us a good leading indicator for the following year. So for me, it's a really key metric and one that we'll be using and seeing a lot more of going forward.
And from a funding perspective, the recent restructuring left you with a healthy net cash position. Can you outline your priorities for investment over the medium term?
Yes, I can. We've already talked about it, really, growth. We've said in previous announcements and in our interim results last year that despite some of the challenges, one of the highlights from this year is that we've been able to maintain our investment in our core product and still move that forward and progress our roadmap as we would have liked to this year, which is a big highlight and a win for us. Now we turn our efforts a lot more to sales and marketing platforms and really focusing down on that increase in subscribers. So sales and marketing definitely, and with the US coming into that as well. So that's one area, and the most significant area we're looking at investing in the short to medium term. The other area is our own internal digital transformation and our digital transformation, our people. We still continue to go through our transformation program. Our executive chairman recently said that change was the only constant now, and I think he's absolutely right. We're definitely not going to sit back and think the job's done, because it's not, and the world is constantly changing. We need to be ready for that. The digital transformation will allow us to have access to our own data and insights, management information that will allow us to make quick decision making and be agile in what can be a dynamic market. So another really important area of investment for us as we look to step into what we will hope will be a rapid growth phase.
That's great. And many thanks again for joining me today. And I look forward to catching up again when you announce your prelims, I believe in April.
Thank you, Catherine.